Hi everyone, welcome aboard to Fresher Platform Global, particularly BCom freshers and the employers and the chartered accountants. And this session deals with transactions, and it is just a glimpse of real-time understanding which I'm going to share. And the session topics are transaction and its understanding with reference to its definition, and kinds or types of transactions, transaction occurrence or the different phases, and accounting life cycle and transaction flow. Now, a very important question: what exactly is the motive force which is running this world? You can relate this particular question with the topic of our session. The transactions are associated with humans in such a way that we cannot avoid them before our birth and even after our death also. So, with reference to my research and analysis on a micro and macro level, I have categorized these particular transactions into two categories. One is commercial activity and the other one is personal activity. And in commercial activity, like the purchase and sale is done okay, the exchange of goods and services, so with an intention to earn profits. So this was something commercial activity, and the personal activity is something which is generally done for the personal consumption or for the utility of the goods. Okay, and sometimes we also sell the goods which we generally purchase for our personal use. It is a different thing, but on the whole, these are the two activities which I have categorized, and if you have any third kind of activity, please let us know in the comment section. And hopefully you have agreed the whole world is doing debit and credit on the whole. Okay, so these are the two terms. Debit and credit are the two terms or the motive force which is running the world. So this was something about this is something about my understanding. Okay, and on the other hand, unfortunately, such important terms don't even have their proper definitions also, uh, and I could not find them in the books of accounts till now. And a statement like transactions occur first and then journalized and accounted. This is my statement, my analysis, and you can analyze it at your end also. And the definition of transaction is, it can be termed as a business activity or an event which involves two businesses or parties for the exchange of goods and services in monetary terms or in terms of money. So these are the four elements or the four dimensions or the four perspectives or the four views or four angles of this particular definition. Okay, one is business activity, and the other one is the involvement of two parties or two businesses. Without involvement of two businesses, a transaction cannot occur. Okay, and the third is for the exchange of goods and services. The purpose is to exchange the goods and services in the terms of money. Okay, so which are recorded in different journals. The different business transactions are generally recorded primarily in the journals only. Okay, and now the types or kinds of transactions: accounting transactions, non-accounting transactions, inventory transactions and non-inventory transactions, internal transactions, adjustment transactions or adjustment entries. The first and last are with reference to the manual and computerized accounting, and the middle four transactions or kinds of transactions are recorded on a computer application or on an ERP. Okay, or a computer accounting software. The first one is accounting transactions. With reference to both manual and computerized accounting, the transactions which are recorded in the subsidiary books or books of accounts or subsidiary journals, like purchase returns, sales returns, cash book, journal proper, bills receivable, bills payable. These are the 8 subsidiary books which generally the students know. Okay, so with the perspective of manual accounting, and even in the computerized accounting also, these transactions are recorded. Okay, the purchase returns and sales returns are known as like the debit note and credit note in the computerized accounting. Okay, Ultimately, after recording these transactions, they will affect the core financial statements. The core financial statements are like trading account, profit and loss account, and balance sheet. Okay, so they will impact somewhere somehow the different financial statements. Okay, and the second one is non-accounting transactions which do not affect the financial statements. Okay, first is accounting transactions and the second one is non-accounting transactions with reference to the computerized accounting. It is not these non-accounting transactions are not recorded in the manual accounting. Okay, which do not affect the financial statements, like purchase order, sales order, request for quote. RFQ means request for quote, and sales quote. Okay, purchase order is something like, at our end it is a purchase order. If we are placing an order to our supplier, it is a purchase order for us, and at the other end for the supplier it is a sales order. So these are the two aspects, in our perspective and in the vendor perspective, or the creditor's perspective, or the supplier's perspective. Okay, so the request for quote is at our end and it is a sales quote for them. Okay, but do have a financial character. So these transactions do have a financial character. For example, if we are placing a purchase order, so in that purchase order, the number of items which we are ordering with our supplier or our creditor or our vendor will be available in our purchase order. Like if we are ordering 10 different goods, and the quantity will be there, and the unit rate will be there, and the total amount of that particular purchase order will be there. So these are the four things which are available in the purchase order. Directly or indirectly, you can also understand it as like the transactions which do have a financial character and expressed in terms of money, or the four elements. Okay, it is a business activity, or business activity with the involvement of two businesses or parties for the exchange of goods and services in monetary terms. Okay, these are the four elements which are present in these all transactions. But on the other hand, they do have a financial character, but they will not affect the financial statements. Okay, because the purchase order, for example, if we are considering the purchase order, like we are just placing the order. Okay, we did not receive the order, we have just placed the order. So we did not receive the inventory, and the supplier also did not send their goods. So the reason they are in the initial phase of the procurement. Okay, or the initial phase of the sales. At the other end it is a sales order, at our end it is a purchase order. I hope it is clear till now, guys. And the third activity, or the third type of transaction is inventory transactions. Okay, these are the transactions which will impact the physical inventory and not the financial inventory. Financial inventory refers to the closing stock, and the physical inventory refers to the stock available at our warehouse. Okay, so this is how the MRN or GRN and delivery note or the delivery challan will be affected, or these are the transactions. By recording these transactions, the inventory at the warehouse will increase, but the closing stock will not be affected. Okay, material receipt note, we just receive the goods at our warehouse, or the delivery challan is something which has been sent by our supplier to us at our warehouse. Okay, so by receiving or by recording these transactions, the inventory will increase but not the closing stock. Okay, so the closing stock will increase at the time of billing or invoicing. Okay, so the other two examples, like the debit note and credit note, in case of these two transactions, the inventory will decrease and the inventory will increase also. Okay, for example, debit note, that debit note means the purchase returns. Purchase returns means the inventory which we have like purchased from our vendor, we are returning back to our vendor. So the inventory at our warehouse will also decrease, and the closing stock will also decrease in case of debit note. And in case of credit note, the customer will send the goods which we have already sold to them with credit note. So the inventory at our warehouse will increase and the closing stock in our balance sheet will also increase. So this was something about the inventory transactions. And non-inventory transactions, they are in the perspective of inventory, and the inventory transactions were in the perspective of the financial terms, and this is in the inventory terms, okay, which will not affect the inventory. Okay, purchase order and sales order and request for quote and sales quote they are the non-inventory transactions. And the internal transactions are like material request, material indent, or material requisition, or material issue or receipt, and material transfers from one warehouse to other warehouse. These are some examples or some transactions which occur within the organization, and the other party or business is not involved in these transactions. I hope it is clear, guys. So by recording these transactions, the other party is not involved. Okay, it is an internal transaction. Adjustment transactions are something which will affect the financial statements, like the profit and loss account will be affected and the balance sheet will be affected. Everyone knows about the adjustment transactions. They have a dual effect. Okay, at the month ends we do the adjustment transactions or the accruals or the periodic transactions also. Now the occurrence or phases or life cycle of transactions. Okay, there are three phases of transactions, like daily transactions, monthly transactions and yearly transactions. These are the different phases or of the transactions. Daily transactions refers to purchase, sales, purchase returns, sales returns, or debit note and credit note, and delivery notes and material receipt notes, and cash and bank deposits, cash and bank withdrawals, cash and bank payments, and cash and bank receipts, etc. So these are the daily transactions, or the frequency of these transactions is quite irregular. Okay, and the month ends or periodic or accruals or adjustments. These are the monthly transactions. Like accruals particularly refers to expenses incurred but not paid, and incomes earned but not received. So for example, expenses means I can take an example of salary. Salary for this particular month is recorded in the profit and loss account, and the outstanding salary is shown in the balance sheet on the liability side. So this is something the salary, the expenditure has occurred but we did not pay the salary. So the reason we are showing as a liability in balance sheet, and the salary expenditure is shown in the profit and loss account for this particular month, irrespectively that whether it is paid or not paid. Okay, so the same in case of rent also, electricity also. There are different expenses which are adjusted on the month end, on the last day of the month. So they are known as the periodic or month ends or accrual or adjustment transactions. And the yearly or like year end transactions are the transactions which are recorded on the last day of the financial year. That is also a month end, but done on the last day of the financial year. So this is something about the year end transactions. Now accountancy or accounting data flow, or the accounting life cycle. So the accounting life cycle refers to the journal, ledger, trial balance, final accounts, like summarizing the final accounts, preparing the trading account, profit and loss account, and balance sheet. These are the different phases or the life cycle of accountancy or accounting. And accounting refers to the recording of transactions, recording the business transactions in the books of accounts is known as accounting. But whereas the accountancy is something which is complete life cycle, recording, classifying and summarizing the business transactions, and interpretation of the reports to the management. Okay, so this is something about accountancy. And the transaction flow, as far as the transaction flow is concerned, the transaction flow starts with the journal and ends at the ledger, and from the ledger the transaction will not flow, but the balances of the transactions will be taken as a trial purpose. Okay, so that is in the trial balance we make the adjustments. Okay, so before adjusting the trial balance it is known as the unadjusted trial balance, and after adjusting after recording the adjustment entries it is known as adjusted trial balance. Okay, so this was something about the ledger, so I mean sorry, the data flow of a transaction. Okay, the transaction flow or the final destination of a transaction is ledger. Okay, so this was something about the data flow, life cycle, and accountancy and accounting. I hope you are clear till this point. In simple, what we have understood is the transaction life cycle, or all the possible dimensions of the transactions were discussed in this particular session. And thank you for watching this particular session of transaction, guys, and requesting you to like, share, and subscribe our channel, and see you in our next session. Till then, have a wonderful day, guys.